This presentation is brought to you by lostjobstartbusiness.com, a website where you can get lots of free resources on how to set up and start a business after you've lost your job. For many people who have decided to start their own business, putting together financial projections is scary. Most aspiring entrepreneurs don't know where to start. This is understandable because most entrepreneurs are not from a financial background. They often outsource it to an accountant and never get to grips with their own financials. Believe me, this is a major mistake. Understanding your financials is a key element to your overall business strategy. The good news is that anyone, and I mean anyone, can do their own financial projections. In this presentation, we will cover how to construct your sales and expense assumptions, then how to tie these into your income, cash flow and balance sheet projections. Not familiar with spreadsheets and suffering from a small dose of finance phobia? Don't worry. All you need to know is how to add, subtract, multiply and divide. I have designed this system of constructing financial projections to be very simple, yet extremely effective. The first thing we are going to look at are your sales assumptions. You should avoid the cliched percentage of total market share approach. Instead, build them from the bottom up. At this point, you need to have a clear idea of your business model, especially your sales funnel. Basically, at the top of your sales funnel are people who walk into your shop, unique visitors to your website, people who call your sales hotline, people who agree to a free consultation, etc., etc. At the bottom are people who have actually bought your service. You must identify realistic conversion rates for each part of your sales process. In order to do this, read industry journals, forums, post questions online, observe similar websites, shops, businesses, read annual reports. The main thing is to come up with a realistic starting point. When you are up and running, you can revise your conversion rates to what you are actually achieving. The key at the start is to use reasonably realistic assumptions. The more accurate you can be, the better. In this example, let's assume that the business makes sales on their website. We will use Google Traffic Estimator to estimate traffic along with the cost of achieving that traffic. The traffic estimate goes into the top of your sales funnel, and the cost, which is also displayed in the estimate, goes in as a marketing expense. If you have multiple sales avenues, do a sales funnel for each. For this example, however, we are just going to focus on one sales funnel for clarity's sake. If we get organic traffic, it's a bonus. However, the reason why we don't include an assumption for it is that it's very hard to estimate. If organic traffic is achieved when the business is up and running, then it can be included in revised projections. Before you start, it's just too much guesswork. For this example, we have read in a trade journal that the typical conversion rates in the industry are 22% mailing list sign up from unique visitors and 1.5% conversion from mailing list subscribers to sales. However, we must remind ourselves that this is for established websites that have been analyzing website data and constantly improving over a number of years. A startup will naturally have lower conversion rates because it has not yet refined its sales funnel. So off the bat, let's assume a 15% mailing list subscription rate and that 1% of mailing list subscribers will actually buy the product. It's achievable when compared to the industry standards. The conversion rates will improve as the business gets better at selling. So let's take these conversion rates and apply them to our sales funnel. Unique visitors at the start convert at 15% to the next stage, which is the mailing list. Then 1% of mailing list subscribers convert to sales. Now we have the total number of sales. The next step is to multiply this by the sales price. Now take note, when you use a spreadsheet, multiply the cells together because you can change them later and the model will automatically recalculate everything. Now that we've the sales assumptions done, let's look at our expense assumptions. This is actually quite easy because you need to get actual prices and quotes. Go online and pick up the phone. Do not guess these. Get the quotes. You have no excuses, just go out and do it. One thing you should be aware of in this particular section is depreciation. Include depreciation in your projections. It's about the useful life of your assets like machines and trucks. So anything that is going to last for more than 1 year needs to be depreciated to show the amount of use that was used up in that year. Simply put, if a machine has 4 years useful life to the business, then you will use 1/4 of its value in 1 year. That's depreciation. And this depreciation figure will be included later in your income, profit and loss projections. Once you have this done, you should move on to your income and profit and loss projections. In this example, we have done these projections over 3 years. 5-year financial projections have been ditched for 3-year financial projections by most entrepreneurial theorists because it's just too difficult to be accurate 5 years out. Here you should reference your sales from your assumptions page. Don't type the number in the cell, link it back to the cell in the assumptions page. Do the same for each of your expenses. Now subtract the total expenses from the total sales to get the profit or loss for each year. To think that before you would have paid an accountant thousands of dollars to do this. See, once you've created your assumptions, the rest is actually quite easy. Okay, just remember that when you are doing multi-year income, profit and loss projections, include the retained profit in your balance sheet. This is carried forward to the next year. Let's move on to your cash flow. This is how you monitor what your bank balance will be. It's very important. You must work out when payments will be made and when you will receive payments from sales. Now, as a startup, you will probably have to pay upfront and receive payment 30 days or more after the sales are made. Now, you will have to plug the gap in your bank account that this will create. How you do this depends on the type of business that you've set up. In my opinion, it's always better to have a business model where you get paid when you make the sale. Any sale that you have made in the income, profit and loss projections that will not be paid in the cash flow for that year will go into the projected balance sheet as a debtor. Likewise, any expense that appears in your income, profit and loss projections and does not appear in your cash flow should appear as a liability in the projected balance sheet. Just a side note here. For clarity's sake, tax has not been included in this example. So once you have your projections done for your management and strategic purposes, make sure you have enough cash in your cash flow to pay any tax liability that you may have incurred. As you can see, the cash flow is straightforward if you have a clear understanding of your business model. Moving on to the final part of your projections, the balance sheet. In summary, the balance sheet is a list of what your business owns in assets and what it owes in liabilities at the last day of the year. This is then compared to what has financed your business for that year, such as retained profits, investment, or any long-term liabilities such as loans that you've taken out. In other presentations, we will be looking at the income, profit and loss along with our cash flow and balance sheet projections. But for now, this is a great start for you to begin doing your financial projections for your business plan. Remember to check out lostjobstartbusiness.com. That's lostjobstartbusiness.com, where you can find more information on how you can start a business.